Ever feel like you're just drowning in data when you look at a company report?
Hmm.
We're going to try and cut through that today.
Yeah, it can be a lot.
We're diving into Newmont Corporation's first quarter of 2025. We've got their official Form 10Q filed end of March.
Right.
Basically, we're giving you the quick version, the key takeaways on what's going on with this huge mining company.
Exactly. These reports, they have everything, financials, risks, you name it. But honestly, who has the time to read it all cover to cover?
Not many people, I guess.
So our mission here is simple. Pull out the important stuff. What's Newmont's performance been like? Any big changes? What does it all mean for them? And maybe, the mining sector overall.
Without getting totally bogged down in the details.
Precisely. The essential insights, none of the fluff.
Okay, let's jump right in then. Big picture first.
Yeah.
How did Newmont do financially in the first 3 months of 2025? What's the headline?
Well, the immediate thing that jumps out is the net income, specifically the income for Newmont stockholders. It was $1,891 million.
Wow, okay. How does that compare?
That's the kicker. Compared to Q1 last year, 2024, when it was only $166 million, that's a massive increase, like $1,725 million higher.
Okay, hold on. $1.7 billion higher. What on earth caused that kind of jump? That's huge.
It really is. A couple of big things drove it. First, higher sales revenue, and that was mainly because gold prices were way up.
Ah, okay. Gold prices have been strong. How much higher are we talking?
The average price they actually got for their gold, the net realized price, went from $2,090 an ounce in Q1 24 up to $2,944 in Q1 25.
Nearly $3,000 an ounce. Okay, that makes sense. That alone would boost things significantly.
Definitely. And even the gross price before certain adjustments went up quite a bit too, from about $2,082 to $2,890. So yes, strong prices were a major tailwind, no doubt.
But you said a couple of things. What else was going on?
The other really big factor was a net gain from selling assets they'd marked as held for sale.
Ah, divestitures. Which ones?
During the quarter, they finished selling CC&V, Musselwhite, and Eleanor, and these sales resulted in a pretty substantial gain on their books.
Unlike last year, right? Weren't they writing stuff down then?
Exactly. Last year, in the same period, they actually recorded a loss because of write-downs on assets they planned to sell. So this is a big swing.
Do we know how much gain came from each sale?
Yeah, the report breaks it down. It was about $2 million from CC&V, $19 million from Musselwhite, and the big one was Eleanor at $172 million gain.
And the total cash they got from those sales?
Total proceeds were $860 million.
Mm-hmm.
So almost $1.9 billion came in the door from those deals.
Okay, so it wasn't just high gold prices padding the numbers. They were actively selling off parts of the business, and that contributed significantly to the profit surge.
Absolutely. It points towards a deliberate strategy. They also had some unrealized gains on investments, but the sales and the gold price were the main story.
Was there anything dragging profits down, offsetting these gains?
Well, income tax expense was higher, which you'd expect with higher income, but it wasn't enough to counteract those big positive factors.
Got it. What about other measures like adjusted income or EBITDA? Did they look strong too?
Yes, they did. Adjusted net income was up significantly from $846 million last year to $1,404 million this quarter.
Another big jump.
And adjusted EBITDA saw a really impressive rise, too, up 55% actually, from about $1.7 billion to over $2.6 billion.
Wow, 55%. That's strong. And cash flow, how did that look?
Also very healthy. Net cash from operating activities more than doubled, jumping from $774 million to over $2 billion, $2,031 million. And their free cash flow looked good, too, at $1,205 million.
So financially, a really strong quarter driven by prices and those strategic sales. Let's talk more about those sales. This seems like a big strategic push.
It definitely looks like it. Optimizing the portfolio, as they'd call it, those 3 sales completed in Q1, CC&V, Musselwhite, Eleanor, bringing in that $1.86 billion. That's significant.
And it didn't stop there, did it? Didn't they sell more stuff after the quarter ended?
That's right. In April, so just after this reporting period, they finalized the sales of Akiem and Porcupine.
How much did those bring in?
The pre-tax cash was about $1,088 million, net of some working capital adjustments. So yeah, the selling continued.
So as of the end of March, when this report cuts off, what was still on the for sale list?
At March 31st, the assets still classified as held for sale were Akiem and Porcupine, which we now know were sold in April, and also the coffee development project.
Okay, so clearly a pattern of divestment, shedding assets, focusing, maybe simplifying.
That seems to be the goal, yeah. Focusing capital, maybe reducing complexity or risk, a clear strategic direction.
Right, so that's what's leaving the portfolio. What about what they're actually digging out of the ground? How is production in Q1?
Okay, so attributable gold production that came in at 1.5 million ounces for the quarter.
1.5 million. Okay. And they mine other stuff too, right? How do they account for that?
They use gold equivalent ounces, or GEOs, for the co-products. In Q1, that added another 348,000 GEOs.
And what metals make up those GEOs?
That was mainly from, let's see, 35,000 tons of copper, about 6 million ounces of silver, 22,000 tons of lead, and 59,000 tons of zinc.
How does that 1.5 million ounces of gold compare to last year?
Good question. It was actually down slightly. In Q1 2024, they produced just under 1.6 million ounces, 1.599 million to be exact.
Interesting. So profits are way up, but actual gold production dipped a bit. What about the other metals?
Also a bit of a mixed bag compared to last year. Copper production was down, silver was down, lead was down too. Zinc, however, was actually up a little bit.
So volumes weren't necessarily the driver for the higher revenue. It really was the price, especially for gold.
Primarily, yes, though the mix of metals matters too.
You mentioned gold equivalent ounces GEOs. Can you maybe just quickly explain that again? And did anything change with how they calculate it?
Sure, so GEOs are basically a way to combine all the different metals they mine into one single number, using gold as the common unit. It helps compare total output.
Based on prices, I assume.
Exactly. They use the relative market prices. And here's a key point for this year. In 2025, Newmont actually updated the metal prices they use for this calculation.
Oh, how so?
They aligned them with their long-term reserve price assumptions. The effect of this change, using these new 2025 prices, was actually that the calculated GEO figure was lower than it would have been using the old 2024 prices.
How much lower?
They estimate the change itself reduced reported GEO production by about 78,000 ounces and GEO sales by 82,000 ounces just because of the calculation change.
Huh. So even if they produce the same amount of copper or silver, it translates to fewer GEOs now because of the price assumptions they're using.
Correct. It's a subtle but important detail, could reflect a more conservative long-term view on relative metal values, maybe.
Good to know. Okay, let's shift to costs. Getting all this metal out isn't cheap. What do the reports say about their operating costs?
Right. They report two main metrics: costs applicable to sales, or CAS, per unit, and all-in sustaining costs, AISC, per unit.
And what were the trends there? Up, down?
Kind of mixed, actually. For gold itself and for the combined gold equivalent ounces, both CAS and AISC per unit increased in Q1 2025 compared to Q1 2024.
So it costs more to produce each ounce of gold.
Yes. But interestingly, for their other main metals, copper, silver, lead, and zinc, both CAS and AISC per unit, actually decreased.
Any specific reasons mentioned for why gold costs went up while others went down?
Yeah, they give some examples in the detailed operations discussion. Like at Cerro Negro, they had some temporary shutdowns because of safety incidents.
Oh, okay. That would hurt efficiency.
Definitely. Lower production means fixed costs get spread over fewer ounces, pushing the per ounce cost up. They also drew down inventory there. It highlights, the operational risks involved.
Any positive examples? Things driving costs down?
Sure. At the Brucejack mine, they apparently had higher throughput in the mill, which helped lower the cost per ounce there.
Okay.
And another factor is currency exchange rates. Like in Mexico and Argentina, the local currencies weakened against the US dollar.
Which makes local costs cheaper in dollar terms.
Exactly. So that helped lower their CAS per gold ounce reported in US dollars for operations in those countries. It's always a mix of site-specific things and broader economic stuff.
Makes sense.
Yeah.
All right, let's talk liquidity. How are they fixed for cash? Any concerns there?
Doesn't seem like it. At the end of March, they were sitting on a pretty hefty pile of cash and cash equivalents, about $4.7 billion. $4,730 million specifically.
That's a solid cushion. What about borrowing ability?
They also had their full revolving credit facility available, which is another $4 billion they could draw on if needed. So yeah, plenty of liquidity, lots of financial flexibility.
So with all that cash and access to credit, what are they planning to do with it? What's the capital allocation plan?
Well, according to the report, the priorities are kind of multi-pronged. They want to self-fund their projects, look for strategic partnerships.
Rover stuff.
Right. But also, debt reduction is a focus. And importantly for shareholders, returning cash through dividends and share buybacks.
Did they actually buy back shares in Q1?
They did, yeah. They spent $348 million repurchasing their common stock during the quarter. So they're actively returning capital alongside reinvesting and paying down debt.
Seems like a balanced approach.
Mhm.
Did they mention any worries about the broader economy, inflation, supply chains, that kind of thing?
They did acknowledge those. They mentioned they're actively monitoring inflation, potential supply chain issues, and uncertainties in the labor market. Standard procedure, really, but important headwinds to keep an eye on.
Yeah, absolutely. Okay, mining always has environmental aspects and potential legal issues. Anything noteworthy in the 10Q on those fronts?
On the environmental side, the big number is their total liability for reclamation and remediation. As of March 31st, that stood at $7,367 million.
Almost $7.4 billion. That's a huge long-term obligation.
It really is. It shows the scale of the cleanup responsibilities. They also gave an update on one specific situation, water quality rules at the Yanacocha mine in Peru.
What's happening there?
They're working to meet updated regulations, and they've got an extension now until June 2026 to fully comply. They mentioned having 5 water treatment plants running and plans for more. It just kind of illustrates the ongoing effort and investment needed for environmental compliance.
And any major legal things going on?
They mentioned a couple. There's a securities class action lawsuit, Caras versus Newmont, basically alleging misleading statements about future revenue and production grades.
Okay.
And then there are some related derivative lawsuits, like one called Gunderson, raising similar concerns about disclosures and internal controls.
What's Newmont's position on those?
In both cases, the report states they intend to defend themselves vigorously. Pretty standard language, but it shows these are active issues they're dealing with. Highlights the kind of legal scrutiny these big companies face.
Understood. And finally, these reports always have those forward-looking statements. What's the quick takeaway there?
Just the standard but crucial reminder. When they talk about expectations, projections, future plans, those aren't guarantees. They're subject to all sorts of risks. Metal prices changing, costs fluctuating, regulations shifting, unexpected operational problems. You name it. Actual results could end up looking quite different. So view those projections with that context in mind.
Good reminder. Okay, let's try to wrap this up. If you had to boil it down, what are the absolute key takeaways from this deep dive into Newmont's Q1?
I'd say, number one, really strong financial results for the quarter, driven largely by those higher gold prices, but also significantly by the gains from selling off assets.
Right, the divestitures.
Exactly, which leads to point two. They're actively reshaping their portfolio. Selling off non-core assets seems to be a major strategic focus right now.
Even though actual gold production was slightly down.
Correct. Which is interesting. Financial health improved dramatically. Net income, EBITDA, cash flow, all way up, but gold volume dipped. They're managing costs, seeing some increases for gold, but decreases elsewhere, and they have strong liquidity.
And they're deploying that capital across growth, debt reduction, and shareholder returns.
Yep. While also, navigating the ongoing environmental responsibilities and some legal challenges. It's a complex picture, but financially, Q1 looked very positive.
So, thinking beyond just the numbers in this report, what kind of questions should this raise for us, for the listener?
Well, you really start to wonder about the long game, right? How will this more focused, maybe smaller portfolio perform down the road? Does selling assets now position them better for the future, or does it limit growth potential?
Good questions.
And what does the slight dip in gold production mean? Is it a temporary blip or part of the strategy? Also, those environmental and legal issues, what are the potential long-term financial or operational impacts there? They bear watching.
Definitely things to keep an eye on. If someone listening wants to dig even deeper, where should they go?
The best place is always the source, the full Form 10Q filing. It's dense, but all the detail is there, including the notes to the financial statements. You could also look for analysis from financial experts who cover Newmont specifically. And just generally, staying informed about trends in the broader mining industry gives important context.
Makes sense. Well, it's clear that while these quarterly reports give us a snapshot, the real story is in the strategic shifts and the ongoing challenges. It's certainly an evolving picture for Newmont.
It always is in this industry.
Thanks for unpacking that for us. And thanks to all of you for joining us on this deep dive.